Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Once silver became used in industry, then you started to see this change in the gold-silver ratio where we've been over 100 a few times. And what's interesting is silver comes out of the ground back in the 13th century at a ratio of 12 ounces of silver per ounce of gold. Now we're down to 7 ounces of silver per ounce of gold. So based on the natural ratio that's dropped almost in half, silver's price is over 80 to 1, and yet you go back to the 13th century and it was about 15. So obviously silver's not valued as money right now. It's valued for its industrial quality zone.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. What is the monetary system, and is it rigged? How can knowledge of how the system works help beginners to invest more wisely? Joining me today to talk all things precious, metallic and monetary is David Morgan. Hello, David.
Hello, Phil.
David Morgan is a renowned analyst in the precious metals industry and the publisher of the Morgan Report. He has over 40 years of experience consulting for hedge funds, high net worth investors and mining companies, while also educating the public about honest money and sound financial systems. He's the author of the Silver Manifesto and a frequent guest on CNBC, Fox Business and MSNBC. So tell us about your backstory and how you came to this point in your life critiquing the monetary system.
Well, the coinage changed when I was 11 years old from 90% silver coins into what I call the Johnson slugs. And that really kind of piqued my interest about money. And so I kind of caught fire at that point, not like I thought about it daily as an 11-year-old kid, but as I got older and started learning more and more, I really started to focus on banking and how the system works. So that was basically what started me on this path, and I've been on it pretty much ever since.
What are Johnson slugs?
They're cupro-nickel coins that were under the Johnson administration. After the Kennedy assassination, the silver was taken out of the coinage. So instead of having 90% silver coins from 1965 onward, they were silver-looking, but they were copper and nickel. We call them cupro-nickel, and I call them slugs because they don't have any precious metals in them.
Yeah, because there was a time, wasn't there, when precious metals were pretty intrinsic to money, like you'd get a piece of silver or a piece of gold. And yeah, we've really lost that kind of solidity to the monetary system, haven't we?
Exactly.
What inspired you to start the Morgan Report and dedicate your career to educating people about building wealth?
I think one thing is that I have a belief system that may be different than many, but I really believe that most people have 1, 2, perhaps 3 opportunities to strike it big in the financial system, but most don't see the opportunity. I mean, almost anyone would say, geez, if I just learned about Bitcoin, in the first, 3 or 4 years and put in a modest amount, look at where I'd be today. So that's one I think everyone can recognize. One for myself that I did take the opportunity on was the cellular phone industry. It was just starting when I was quite a young man in my 20s. And I brought the opportunity to my dad and we talked about it. And my dad saw it for more than I did, actually. And he said, this to me looks like the opportunity of a lifetime. I'm going to definitely invest into the cellular phone business, which we know now almost everyone on the planet has 1 or 2 cell phones. So that's just 2 examples. So when I started the Morgan Report, I just wanted to give opportunities to people. I do not do a general letter. My letter is on the resource sector, so things we need rather than things we want. So I think, first of all, thank you for having me on the show today. And when it comes to investing, I think most beginners think the hardest thing is picking the right stock. And in reality, the hardest part is really getting the right mindset. So that's what I try to teach in the Morgan Report. And I give opportunities for people from all scales, top tier companies that are blue chips, mid-tier companies, and even speculations. But I weight the portfolio so you can't really make a big mistake. In the speculative section, we weight it where it's money you can afford to lose. So if that's $50 for you, that's $50 for you. It's 500 for you, that's 500. But whatever it is, if you follow the guidance, our members have done fairly well, especially looking at the long term, where the compounded annual growth rate for gold has been about 10% for the last 25 years, whereas for real estate, it's about 8%, and for the S&P, it's about 7%. So gold has actually outperformed. And if you look at the gold stocks, they usually outperform gold itself. So we've done well over the long term.
Tell us a bit about the mindset that you teach.
Well, it's about not chasing the hottest name or reacting to the headlines. It's about creating a process that you can trust. The very best investors understand two simple truths. First, you must protect yourself from risk before you ever think about the reward. And second, real wealth is built slowly through discipline, patience, and the power of compounding. If you're just starting out, you don't need to predict the next Tesla or Amazon. You need to learn how a market works and how to manage risk, and how time does factor heavily, lifting you in the long term, as I just outlined. So you don't want to focus on finding the next lottery ticket. Focus on building a foundation that lasts for the long run. And that's how people become professionals in this business.
I know it's pretty common, isn't it, for people who suddenly discover the stock market, and then the idea is that you're going to be finding that life-changing company that you just invest in, and then in a couple of weeks you're going to be rich. It's really a strange mindset that people have, and I know I've been guilty of this in the past.
Yeah, wealth is built quietly over time in most instances. And Bitcoin might be an exception, but Bitcoin's been around for more than 10 years now. So a dollar invested with discipline and patience today will outgrow $10 thrown randomly at the biggest fad stock. And you really want to set a methodology that works over the long term and stay disciplined. When I started investing, I was 16 years old, which is quote unquote illegal because you have to be 18 to sign a contract in the United States. However, in California, where I was living at the time, my dad signed what's called the Uniform Gift to Minors Act. And if your parents sign that document, the state or the government would allow you to trade stocks. So my dad did it because I was so interested in money, as I said earlier. And I started trading the Dow Jones Industrial Average at 16 years of age. And I held that for a few years. And then, being a kid and all that, I decided to cash out. But I often think if I just left that was rather modest amount, I'm in my 70s now, how that compounding and just the DJI would have done over all those years. Believe me, it would have been quite substantial.
You were an outlaw investor from a young age then. What sort of instrument did you use did you just buy the 30 stocks on the Dow or?
I did not. At the time, there was a mutual fund that you could buy, and it just weighted the Dow. So you just bought a share, 10 shares, 100 shares, whatever it was of this mutual fund. And I forget the exact name of the fund. It's been so many years, but it was basically a duplicate of the Dow. There's a small management fee, but it took kind of the headache out of being a DJI investor. And I thought it was just the smart way to go, which actually it was.
And of course, these days there'd be an ETF or many ETFs to cover
Right,
exactly the same kind of thing. So you mentioned that you talk about resource stocks. And I know there's a lot of people, financial professionals, who avoid stocks in the resources sector because they're seen to be the term of price takers, that they're all dependent on the price of the commodity behind that. Do you see that as a bug or a feature?
Well, I think that it's not a sector that's very well understood. And, if you look at commodities, these are things we need. I mean, you look at the softs, cotton, cocoa, coffee. I mean, we probably live without coffee and cocoa, but cotton would, most of the clothing that we wear.
Speak for yourself there with coffee.
Yeah, right. Okay. And so, but the problem is that there aren't really easy ways to invest in the commodities without the futures market, which is way beyond the scope of this interview and really beyond almost anybody. That's the pros game. It's really something I would encourage all of your viewers, listeners to not do. But there are companies that do stuff in the resource sector. For example, I saw food prices that were going to skyrocket about a year before they did. And some of my members said, well, what do we do to hedge increasing food prices? I said, buy Arthur Daniels Midland, ADM. And ADM at the time I recommended it, I forget the exact price. I think it was 35. But anyway, I looked at it over the last couple of years, and it's definitely actually outpaced what we're quoted as the price inflation in the food sector. So that's an opportunity. But the biggest feature I'd like to talk about is that people, especially in the precious metals, but in the resource sector as well, there's a lot of bottom feeders, people that have really cheap stocks and really big stories. And you want to stay away from those. Again, you want to go to discipline, things that you understand. And if you're going to buy a company, you want to buy a company that produces a bottom line profit. So what's interesting about the stock market, and I learned this from some of the greats, is that if I'm going to buy a company, I'm going to buy a company with the money I have to get the absolute best, most profitable company I can. So I'm looking at women's retail, might buy a dress store that's got a track record and is producing a return of 10 to 15% a year, whatever it is. However, people don't buy the best of the best in the stock market. The pros do. But most retail investors, especially starting out, buy a story stock or they buy a cheap stock. And I think there's a psychology when a stock's at 25 cents or whatever, that, oh my goodness, I've only got 1,000 to invest, but look at all these shares that I have. But it's, again, quality rather than quantity. And you really want to put your money in companies that produce a profit. That's really how the stock market is supposed to function. It does at times, but as things have gone on in this inflationary environment, we don't see the stock movements like we did, let's say, in the 50s, 60s, or 70s. It's a new market now for various reasons.
Take control of your investments. ShareSite has you covered. It's Investopedia's #1 tracking tool for DIY investors. Get 4 months free on an annual premium plan at sharesite.com/shares for beginners. Yeah, we're famous here in Australia for many resources companies. We're very good at digging things out of the ground and selling them around the world. And that's very interesting that you say that you've got to look for beyond the story, because often, here in the pub, a tip, such and such a company is a good company. I've heard that from someone that this is going to shoot the lights out. How do you work out, like you mentioned, that it's got to be making some money? What is it in the profit and loss statement that you're looking for that demonstrates this?
Yeah, so analyzing a mining company is different than analyzing a retail stock or an automobile company or an airline or consumable or whatever. And so it's a little more difficult. But when you get to a producer, and I've got a stock or a company in Australia, and I've got a company, let's say, in North America, and a gold stock, they're producing the same exact thing, gold. So now, since it's the exact same product, that takes a lot out of the equation that I have to worry about. Now all I have to worry about is what is their resource base and what's their profit margin. I also have to look at how long they can stay in business. So a mining company, the best mining company in the world, ends in failure. In other words, when that last ounce of profitable gold is removed out of the ground, then that company's out of business. Now the large companies completely go beyond a mine and they buy other mines, and they continually are looking to replenish the resources that they do take out of the ground. But it's really not that difficult. You're comparing apples to apples. So who's mining gold the most profitably, and what's the sustainability of the company? Are there political risks? There's more that goes into it, but it's really not that hard once you get a handle on it. As far as the ones that are story stocks, these are exploration companies, and I would encourage anyone new or seasoned to basically stay away from those companies. They are very, very risky, and it's a good way really to go broke. And that was another reason for starting the Morgan Report. When I was very young and aggressive, and I wanted to, shoot the moon in the beginning very quickly, in other words, I wanted to get rich quick, I bought a lot of these stories, and most of them actually shot up for a while gold was running higher. but they fizzled and fell away, and some of them became absolutely worth zero. And then when I started the Morgan Report, I didn't want any of my readers to experience that. So I stuck to the hard lessons I had learned as an early investor into what works and what doesn't.
And there's also a great deal of time and capital investment that's involved from, a geologist coming up and saying, oh, we've got a good seam here that's going to produce a lot of gold. I mean, it can take years before that's actually going to turn into profitability, isn't it?
Absolutely. There's a curve that we use called the Lassonde curve, and it shows how a company that's profitable goes from discovery all the way through to producing. It's very interesting. To discovery, the stock shoots up really high and gets overvalued. Then reality sets in and the market reprices it down. That's what really is in the ground. And then it kind of swallows around up and down for a long time until the mine is actually built. And if the mine is built and everything on the preliminaries are accurate or near accurate, then the company will slowly start building up. So there's a lot to the investing game in the resource sector. But if you know, like, all the rules or the cues, you can do well.
And you like to look at companies that produce whatever precious metal is, for example. What is the relationship between the price of, say, gold and a gold producer, and why are the returns and I guess the losses, why are they so disparate?
Just for the record, we look at almost everything in the resource sector that's metals related. So we've looked at lithium and copper, even zinc and lead, cobalt. So we look at them all, but primarily these days we do look at gold and silver. And what's interesting in a good gold producer is you usually get about 3-to-1 leverage. So if you buy an ounce of gold and it goes up 10% from $3,000 to $3,300 US or Australian dollars, that same gold stock will go up about 30%. So you get the leverage in it. So if gold goes up a triple, you might get 300%. You might get 900% on a top tier, cash rich, unhedged mining company.
Nice to hear about. I'm interested to hear your views on the monetary system as well. Let's get back to basics again. What is the monetary system?
Well, it's what most people think of as the economy, but the economy is really goods and services traded amongst people on a volunteer basis. But the monetary system is what we consider money. But really, if you look at money from a historical aspect, money is supposed to retain value. And the current system doesn't, because it's not tied to anything of value. Money is not gold or silver, as it has been many times in the past, that maintains value. And the current system, which is called a fiat system, which means by edict, or I announce, or I edict, I say that this is money. And of course, that's backed up by force by governments around the world. The Aussie dollar is legal tender at law, and you need to pay your taxes with it. So you have to earn it. But those systems always depreciate the currency. So the Aussie dollar that bought a house in 1970 for $40,000 probably costs $400,000 now, and it's the same house. So what happened? The house didn't change. What changed? Well, the price changed because the currency lost more and more value over time. Money doesn't do that. Money maintains the same value over time. So if that house cost, for example, 20 ounces of gold, it would probably cost 20 ounces of gold. Back in the 1970s, I think I said, it probably cost 20 ounces of gold today. So that proves that gold, in the long term, I mean, it fluctuates up and down like everything, but in the long term, it will maintain its buying power.
And you believe it's rigged as well. And at this point, I always, like another guest showed in the past, how currency was debased. And that was because kings, for example, would issue currency, and then slowly they'd be starting to replace the gold or the silver with copper, for example, hence debasing it. Is that part of how you see the rigging of the system?
Yeah, there's just more and more dollars that are printed at cost. So in the United States, the Treasury prints the money and sells it to the Federal Reserve at cost, which is about 5 cents per bill. and they sell it at 5 cents, whether it says 1, 5, 10, 20, 50, or 100 on it. So I can buy a $100 bill for 5 cents, and then I loan it to the banking system at face value and interest. So how would you like that business? Start buying $100 bills for a nickel, and then you put them into the system and get 4% return on them on top of that.
So how is the system rigged?
Well, it's rigged because that's counterfeiting. And if you and I did it, we'd be in jail. But there's a special relationship between the banking system and the Federal Reserve, which allows it to have a monopoly on printing the money, and we're forced to take it. But it's still counterfeiting any way you slice it.
Yeah, I'm surprised at the number of people who are not getting this concept. They have no idea about how this works, and that, every time a home loan is issued, for example, that's new money that the banking system is creating as well. And for some reason, people don't seem to get this.
Well, they don't. I mean, they're taught to, believe in authority, and someone has to be the banker. And, there's all these ideas that are floated out there, and they're reinforced all the time. But you're right. When you sign up for a house, the bank has the asset until you pay it off. So their risk is almost zero. But they create the loan just by you signing your name, period. So it creates it out of nothing. The house wasn't created out of nothing, but the loan to buy the house was. And it's very unethical. It's immoral, really. But again, most people just slough it off, don't even know about it. This is where I pursued my career, because I learned that at a very early age, like an 8th grader. And, not many 8th graders says that the Federal Reserve Board is a private corporation. It's not even part of the U.S. government. And when you said that, they thought you were absolutely insane. You couldn't possibly be right about that. Of course, now with the internet, almost anyone that starts to look into money at even a cursory level understands that to be the fact.
So how do you think this undermines personal and economic freedom for ordinary people like us?
Well, the best system is a free market system where people get to volunteer their action, and their labor is compensated fairly throughout their working career. And that's usually an asset-based currency like gold and silver, but it could be done other ways. A paper currency actually could work in theory if the paper that was issued was commensurate with the labor force and the construction and all that goes on in the economy. In other words, there was a one-to-one correspondence between an hour's labor, a widget, a house, an automobile, or whatever. If the money supply equaled goods and services, it could work. And that's why these systems usually start off pretty good, because everything seems to be on sound principles. But what happens is governments start to pay for things that they can't afford, so they borrow money into existence, and then the citizenry is required to pay that money back. So that's why the tax rates keep going up and up and up, but they can only tax so much. They can't tax 100% of your labor. You were a slave at that point. So they depreciate the currency. So you're making more quote-unquote money today than you were 25 years ago, but it probably purchases less goods and services than it did 25 years ago. So the basement of the currency ends up where the money becomes worth less and worth less and worth less, and then it's worthless. And when it's worthless, that's when people wake up and say, oh my goodness, how did this happen?
Does it work in a little bit in reverse in terms of asset prices? Like asset prices just keep on going up because the value of the money is going down. So if someone already has assets, they're just going to, by default, become richer.
Absolutely. It's the stock market in the United States is still making new highs, and most people that are in the stock market are quite happy, and they feel they're ahead of inflation, and in many cases they probably are. But if you look at it from the aspect that an analyst like myself does it, you would know that the stock market peaked in the year 2000, 25 years ago. Because if you go back to the golden constant and you price the stock market in terms of gold, it is actually falling in price. There's a book on the bookshelf back here called The Invisible Crash, written by Jim Dines. And in that book, The Invisible Crash, he does exactly that. He prices the stock market in terms of gold, and realize if an ounce of gold is the same mass anywhere in the universe and its value over time is constant, that's a constant. What's the stock market doing against that constant? It's actually going down, even though the number goes up and up and up. And the number goes up and up and up because there's more and more cash or currency chasing or going into the stock market. So it's got to go up.
That's an interesting ratio then that you're sharing with us about the relationship between the value of the stock market and an ounce of gold.
Yeah, I mean, I know this is a beginner podcast, but CAGR is something that you can learn about at any level. CAGR is the compounded annual growth rate. So that's what I say, keeping this simple. If you put $1 in the bank and let it compound over time, the interest will keep building over and over. And over a long period of time, you'll come out with a substantial sum. The problem is if the money is debasing at the same time it's compounding, you may not be ahead, like in the house example that I gave you. And so you got to be a little careful. I teach people to save in real money and spend in currency. But it is something that looking at gold as a CAGR, so the compounded annual growth rate of gold for the last 25 years has been 10%. The compounded annual growth rate of the S&P 500 over the same 25-year period has been 7%. Well, 10% is a bigger number than 7, especially when it's compounded. So you could see a curve of, if I put 1,000 in the stock market, it'd be worth this. If I put 1,000 in gold, it'd be worth that. And that's the point I wish to convey, is that when you're in what I would consider to be a rigged system, as we've explained, you really want to pay attention to the end game, which I think we're approaching, because in the end game, the problems with a debased currency accelerate. So instead of seeing 5% inflation in a year, it gets to 10 and 15 and 25. And all of a sudden, again, you go from that, my money is worth less, into I think it's going to become worthless. Now what do I do?
Again, thinking about beginners, how would you see the best way to approach a precious metal like gold? Is it through an ETF? It's actually going and buying some bullion yourself, or with gold miners?
Well, for me, I've always taught the same thing. So to remain consistent, gold is usually too high priced, especially for a beginner. There's exceptions. There might be somebody that's got a really good job or been saving in the bank and start ready to invest. But for most, silver is probably the easier, most affordable way to keep in the sound money system for yourself. And I say that's probably the best way to start. So once you've started to build some precious metals, after that, I care, but it's really more up to you. From that point, you could go into an ETF or a mining company or even leverage, which I wouldn't recommend. But certainly once you've established, let's say, a core position that if things don't go well, you're still protected. I think I'll just shout out to this for all of your viewers and listeners. I wrote kind of the 10 commandments of precious metals investing. It's free on the internet. If you just type in 10 rules of silver investing by David Morgan, it's all over the place. There's several websites that have it. And it will give you kind of the easy way to buy and not make a rookie mistake when you're looking at buying gold or silver. And again, I only recommend 10%. So if you are wanting to buy into the real estate market or the stock market, primarily stocks with your channel, that's fine. And you can do well. There are stocks that outperform the gold market. I totally admit that. But again, you want to stick to the principles, but you also, especially now, should be hedged. And hedged only takes about a 10% position. So if you had, let's say, 10% in your portfolio, and you start investing in some top tier companies and you're doing really well, then what you want to do is rebalance, usually once a year, but you can do it every couple of years. And what you do is you look at where you're at. So let's just say we're doing stocks and gold. So you start with 10% in gold and 90% in stocks. And after 2 years, when you do the ratio, since gold has outperformed stocks, like I said, CAGR of 10 and CAGR of 7, after 2 years, you find out gold's now 30% of your portfolio. and stocks are 70% of your portfolio. So now you rebalance, and what you do is you sell off enough gold to get down to the 10%, and you take the 20% gain of gold and you can put that into the stock market. Now, personally, I wouldn't recommend that because I know what gold does over the long term, but that's the way you can balance your portfolio.
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Okay, let's talk about silver, because you've been talking a lot about silver lately. What is it that interests you about silver?
Well, when I got interested in the financial system and the monetary system, I was pretty much sold on gold and why gold did well, and focused almost entirely on the gold market. And then the Hunt brothers came into the silver market and really moved that market. And after the Hunt situation, I started to ask myself, well, why did they buy silver and not gold? Which they did buy some gold. So I just became fascinated with, I wanted to know why. And so I started looking into the silver market, and I discovered a lot of things about why silver really did outperform gold. There is a booklet called Silver Profits in the 70s by Jerome Smith. I actually have a copy of it. And he wrote several books, Silver Profits in the 80s, The New Boom in Silver, The Coming Currency Collapse, Ownership Theory of Money. I've got almost everything he ever wrote, and many others in the honest money or hard money or sound money camp. Vern Myers, who's now deceased, he lived here in Spokane where I am, about how the system actually works and how to navigate the future based on a fiat money system. So it's just something that basically instilled in me.
Because silver also has other uses than just being a precious metal. It's actually used in industrial processes as well, isn't it?
The thing about silver is that they bought it because they wanted monetary protection, because silver, at the time they started buying it, had only been out of circulation for a few years. So most people in that era thought of it as money. And secondly, the industrial component that you mentioned is compounding. So if you go back 25 years ago, 35% of silver's use was industrial. Now it's 65%. Go back 25 years, and what you'll find out is that only 550 million ounces of silver were mined on an annual basis. Now there's 850 million ounces mined on an annual basis. So we've increased production of silver 300 million ounces annually, and yet the ratio or the percentage has gone from 35 to 65%. So if you take that simple math and you look at the mining of 550 million ounces, let's say that was a steady state condition and that's all we had today, then that 65% actually becomes close to 100%. So in other words, industry would be using up all the silver that's mined. It's not because we've increased the mine supply, as I just stated, but it's something to contemplate. Right now, we've been running at a deficit for 4 years, which means we have to eat the above ground stockpile. So in theory, we're going to see where silver is actually going to outperform gold because the industrial demand will not cease. The silver that's required and essential for all the high-tech systems that we have in the world isn't going away, and silver is still the cheapest, most effective, most efficient way to do an electronic, cell phone, microwave-based flat screen TV world.
I believe there's a ratio that exists between the price of gold and silver. Can you tell us about that and whether that's of any use to consider?
Well, I consider it quite substantially just for two reasons. One, it tells you what the value is, gold to silver. So if silver is overpriced or underpriced relative to gold or vice versa. But secondly, I think it's important from a monetary history perspective. So if you go back to the 13th century, so 1300 AD, and you look at gold-silver ratio from that point until now, you'll find out for the 1300s, 1400s, 15, 16, 17, almost to the 19th century, the ratio never got above 20. And the reason is, and I had to think about this, it's obvious after I thought about it for a minute, is that when gold and silver were exactly the same function, meaning they were money and only money, or you could say that they were both money and jewelry or money and jewelry, but they both had the same exact function. The market said that 20 ounces of silver will buy an ounce of gold, or 16, or somewhere in that ratio. Once silver became used in industry, then you started to see this change in the gold silver ratio where we've been over 100 a few times. And what's interesting is silver comes out of the ground back in the 13th century at a ratio of 12 ounces of silver per ounce of gold. Now we're down to 7 ounces of silver per ounce of gold. So based on the natural ratio that's dropped almost in half, silver's price is over 80 to 1. And yet you go back to the 13th century and it was about 15 to 1. So obviously silver's not valued as money right now. It's valued for its industrial qualities only.
That's quite a back test, back to the 13th century. What are your thoughts on cryptocurrencies and digital currencies, and also government-released kind of, central bank digital currencies?
So when the Bitcoin white paper was released, I was one of the first to know about it because the circles I run in and a lot of financial newsletter writers that are contrarians, we know each other. And so I looked at the white paper and I would lean toward being a libertarian more than a donkey or an elephant, but I'm really apolitical. I really don't like the political scene, especially the way it is now in all countries, yours included. But regardless of my political thoughts, the white paper looked pretty good. I mean, it looked like gold in digital form. You were your own bank, peer-to-peer exchange, no bank interference. But all of those statements from the original white paper are basically the opposite now. It's highly traceable. The whales own it. The banking system basically owns it. That isn't used for peer-to-peer transactions. It's too expensive and too slow. So I'm not very favorable to Bitcoin or most of the cryptocurrencies. I'm fine with the blockchain, and I'm sure it's going to be implemented. I don't like CBDCs because I don't want the central bank to have more power than they already do. I want the power of money. It's too important to put in the hands of the authorities. The power of money should be in the hands of the people, which is what we have on a sound money system. If you have gold and silver circulating freely on a voluntary basis, and you and I determine what the value is, if I'm going to buy a book from you or, a tape or whatever it is, and we agree that's a free market system based on value. I don't think we're going to go back to that. I think we're pretty much destined for either a central bank digital currency, which is kind of being resisted. So there'll be a digital currency that's a private enterprise, but it'll still have the same control mechanisms that you have with the central bank. It just won't be the bank doing it. It will be the private bank or private corporation that will look at what you spend, where you spent it, how much it was, what the purchase was, and then it'll tag a lot of things onto it so it could be programmed, meaning it could attach a carbon credit. In other words, well, I had a steak dinner at this restaurant nearby, and steaks, cow emits this much carbon, and then, truck to take it over to the restaurant, and on it goes. So the carbon score is this. My carbon score is too high. I'm not be able to buy meat at a restaurant further down the road because the authorities have determined what the right amount of carbon I can use as an individual is in any given month. I mean, it sounds bizarre, but that's the direction it's going.
Okay, what else are you seeing in your crystal ball? I mean, there's those kind of urges which are coming, and as well with the outcomes of the currency debasement that we're seeing.
Well, I'm seeing a huge contraction in the global economy. This new world order or one world government certainly is kind of out there in the blogosphere, and it's moving that direction, but not as efficiently as it was a decade ago. I mean, there's a lot of nationalism now where we want things to come back and be producing in the United States. We're putting tariffs on everybody. So there's more of it's got to be here first, my country first, that kind of an attitude. Regardless of that political structure, what we're seeing is less production throughout the globe. In other words, China's not producing as much. United States, we're really getting hit hard. All the corporate restaurants that we have, many of them have gone bankrupt and closed down entirely. And those that are remaining have closed a large number of stores. For example, going from like 600 down to 250, closing out 350 stores that were unprofitable. So we're seeing, and that really is not only a recession, it could go into the big D where we get a global depression. And that, of course, is not something anybody wants, but I think we are heading toward a depression. It's nothing to fear greatly. It scares people to hear the word. But in a depression, what happens, or what you could even make more boldly, a financial crisis, that all the wealth stays in place. So yeah, there's less restaurants and less, tanning salons and less movie theaters, but they're still there, whatever remains. So all the wealth that's there now will continue. It's just it gets repriced. So if automobiles cost too much, the automobile manufacturer may go out of business, and he have to wholesale off his lot of automobiles, of trucks. So what happens is the wealth stays in place, but the ownership changes. And that, I think, is what is possible to take place. But since the banks have so much control over the system, they may be able to continue by basically printing up money, buying everything, reissuing it, perhaps at a new price. Because remember, they get their money for free and we have to work for it. And then start a new system and say, oh, we're so sorry this happened, but we're going to kiss it and make it better. We're going to reprice things. And all you have to do is sign up for the new system, go down to your local post office, give us an iris scan. By the way, if you're under this amount of annual income, we'll now provide a universal basic income for you. You don't even have to go to work. Things are going to be great in just a couple of months. Sign up.
David, this has been a bracing discussion. How can people find out more about your thoughts and ideas and the Morgan Report?
Well, I encourage everyone to go to themorganreport.com, and I've put up a special landing page for your viewers and your listeners. So what you want to do is go to themorganreport.com/shares. You don't have to spell out the whole thing, shares for beginners. We're just going to /shares, SHARES, all lowercase, themorganreport.com/shares. And I've got 3 free gifts for you. I've got a paper on investing basics. I've got a movie to watch that explains this probably better than I've done. And then if you're so inclined, I will give you my time, not one of my staff, but me personally, a 15-minute one-on-one call. And since you're in Australia, it'd have to be, the time change, but I've talked to Australia often, London often. And so it'd be, my late afternoon and your morning. And we could have a chat about whatever, how to get started, resource investing, general stock market questions, options, futures. I've been in the financial system for a long time and I have a good knowledge base. Not saying I know everything, but I've got a lot of experience.
David Morgan, that's fantastic. Such a great amount of resources from a guest. Thank you very much for joining me today.
Well, my pleasure. Thank you.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player or tell a friend who might want to learn more about investing for their future.